All right, here we're back again for our valuation, and we are in session 3 and we would talk about the working capital requirement. Okay, remember the formula: equity cash flow, earnings after taxes, plus depreciations minus average investments, and then mutation of working capital requirement. We are going to talk about the working capital requirement mutation and the influence on the equity cash flow. This is very important, but also a lot of fun, you will see. Now, this is the definition of working capital requirement. You have your inventories. If you can't sell your inventories, you have a problem. Your account receivables, your customers don't pay, you have to finance them. Minus those guys who are giving you a finance without asking any interest. There are, of course, the accounts payables, the suppliers, and other eventually non-interest bearing debt holders. So this working capital requirement can be on the asset side of your management balance sheet, but can also be a source of financing, and that means it's on the liability side of your management balance sheet. Let's have a look. All right, this is a normal balance sheet, and in the management balance sheet we will put the working capital requirement here. Now, to know whether working capital requirement is generating cash or is absorbing cash, it's very easy. Just do it this way. These are the sources of financing. Keep the sources of financing for the same amount on your presentation of your balance sheet. And then look to the fixed assets, the working capital requirement, and cash. And then when the working capital requirement decreases, it will create cash. And if it would increase the working capital requirement, it will consume cash. So that's how you can remember what happens when working capital requirement increases. It will eat up the cash. When it will decrease, it will generate cash. And it's this mutation in working capital requirement that we have to put into our formula for our valuation of our company. It looks very easy, but it's in fact a little bit technical to do it right in your formula for the valuation. Important, normally in a lot of cases you have a positive working capital requirement. That means the working capital requirement is on the asset side of a management balance sheet and has to be financed by something. But you could also have a negative working capital requirement. That means that the suppliers, they are a larger amount than the inventories and your outstanding customers. Then it is the working capital requirement, a source of financing. Now, if the working capital requirement is on the asset side of the balance sheet, of the management balance sheet, and the working capital requirement increases, it will consume cash. But if the working capital requirement is a source of financing and it increases, it will create cash. The opposite way, if the negative working capital requirement, which is a source of financing, is decreasing, it will consume cash. And if the positive working capital requirement is decreasing, it will generate cash. So you do see that to understand the evolution of the working capital requirement is very important, because it will influence in a major way your cash flow and the valuation of your company. All right, these are inventories, customer suppliers. Do we consume cash? You don't know if you are putting everything separately. So what are you going to do now? We just put it all together and it's called the working capital requirement. And now you see the evolution of the working capital requirement. If this working capital requirement is on the asset side of the management balance sheet, it is consuming cash. And if it is consuming cash, you will have to deduct it in your formula when you calculate the equity cash flow. It's logic. This company is making, I hope for them, profits, is making net operating profits, but it could be that their net operating cash flow is negative because the working capital requirement is consuming a lot of cash, as you can see here on this figure. Now, evolutions are very important. This is another company, and here you see that they are decreasing their working capital requirement. They are creating cash. Now, very important in valuation, when the company has an constantly increasing working capital requirement, you will deduct this increase, this average yearly increase from your cash flow. But when the company is decreasing its working capital requirement, you will not put it in the formula for the equity cash flow calculation. And the reason is very simple. You actually, when you're calculating the value of the company, you're making a valuation for the future, for a long future. And a working capital requirement will never go down forever. So that's the reason why you should not put in to your formula a decrease of working capital requirement. Another reason why you should not do it, suppose that this 18% going to approximately 12-13% is 6%, and they have a turnover of 1 million euros. That means 6% of 1 million euros is 60,000 euros, and if you would make an actualization with a cost of equity of 10%, means that you would add 600,000 value to the, that you would calculate 600,000 more in value just due to the decrease of the working capital requirement. And you feel that that is not very logical. So what is important, increases, you take them into account by deducting in your equity cash flow calculation. Decreases, you are not putting this decrease, this mutation in decrease into your formula for the valuation of your company, because accidents will happen then. Okay, important correction. When you're calculating your working capital requirement, your dividends, normally your accountant will book a dividend from last year as dividend to be paid out. And this dividend to be paid out is normally an other debt. And if you have another debt and it is a dividend, you know that the people normally, the shareholders, will take their dividend. So what do? You do add back your dividend and you do deduct it from your liquidities. Now, this is an example of the calculation of an equity cash flow you will be using to evaluate your company. You take your ordinary profits, you deduct your budgeted taxes, you do add your depreciations and your provisions, and we then have what we call an ordinary cash flow. If you have loans to be paid back to the banks, and I will come back in session 4 on this item, but suppose you have 700,000 to be paid back to the banks. After you paid back the banks, you still have 770,000 euros or dollars. It's called the coverage. Now, what is important? You have here 770,000 cash flow. You then go to the working capital requirement. And what do you see? You see that we have minus 425,000. That means there has been an increase in working capital requirement. If it's the working capital requirement on the asset side of the management balance sheet, what in 90% of the cases is the case, then you only have 345,000 euros or dollars left. And if you say the average investments are 600,000 and a yearly provisions to be booked or 70,000, you have a negative equity cash flow of 324,000. And you're having a balance sheet and you are calculating the mutation of the working capital requirement. In a lot of cases, the working capital requirement that you are calculating is the wrong one to be used in the valuation. And the reason is very simple, is this one. If you think about the working capital requirement in practice, businesses, they are trying to have an inventory that is as low as possible. Their customers, they try to get their money as fast as possible from their customers. But the suppliers is something they can influence themselves. And now look at this one. This company has paid last year the suppliers in 30 days. But this last year, they paid the suppliers in 21 days. So they are paying their suppliers 8 days faster. That means that the absolute amount of the suppliers has decreased. But if the absolute amount of the suppliers is decreasing, the working capital requirement will increase. Because inventories and your customers, they are the same amount, but your suppliers, the amount has decreased because you said, oh, I'm going to pay them faster. And so you're influencing, or the company is influencing the working capital requirement, and that's the reason why you have such a high minus 425,000. The question is, what would it be? Now, let's suppose that this company has to pay normally their supplies in 30 days. What would be the amount of the supplies and what would be the mutation? In the previous slide you saw that approximately 400,000 euros was consumed in liquidity by the mutation of the working capital requirement. Problem is you have always to recalculate the working capital requirement. This is the formula concerning the suppliers. Suppliers divided by purchases plus VAT. In my example, I will take the VAT on 0, multiplied by 365 days will bring you to the number of days the suppliers have been paid or outstanding. Now, if you have this formula, what can you do? If you take, for example, 90 days, you say the suppliers can be outstanding for 90 days. This then becomes 90. You multiply by 8,589,000, you divide by 365, and you have an amount of supplies that can be outstanding of 2,118,000. If you would do the same thing with 30 days, you will have 706,000 outstanding suppliers, and you see that we had 496,000 suppliers. That means when you make a valuation, your question must be, what are the normal days that a supplier can be outstanding? You see that companies are paying back their suppliers much faster. They will consuming cash, but this is not a consuming of cash. You have to take into account for your valuation, because you're influencing themselves, these suppliers, this number of days of suppliers. So this 496,000 we had could, if it's 30 days, normally the supplies are outstanding, could be amount of 706,000. And then your mutation of your working capital requirement won't be 400,000, but will be approximately 300,000 less. And even this company has the possibility to pay their supplies in 90 days, the supplies would be an amount of 2,118,000 euros. And then, of course, the whole mutation of this working capital requirement you had on the previous slides has no sense to be deducted in your equity cash flow formula. So one of the most important things when you make a valuation of a company is knowing what the normal number of days are that suppliers can be outstanding in that company as a normal situation. Now, in this situation, we know they are paying back much faster. Suppose it's 30 days, you know this mutation then only is 100,000, then you take 770,000 minus 100, 670,000, but you have here an average investment of 670, you have an equity cash flow of 0. Suppose it's 90 days, then you know they still have a lot of possibilities to have much more supplies outstanding, then it will be 770,000 minus your average investments minus your provisions and bring you about a positive equity cash flow of about 100,000. So this shows that mutation of working capital requirements always have to be recalculated when you're making an equity cash flow calculation for your valuation of a company. Alright, so if you understood, tell me on YouTube. If you did not understood, please tell me also on YouTube. I will make a new video then. See you back.